Chakri, good morning. This is Agam, if you can hear me. Well, my question really was to do with the earnings outlook for the upcoming quarter, as well as to what extent the markets have priced in these earnings. What is your view here?
I think, good morning, post the corporate tax cut that has happened. So that will clearly bump up earnings for all companies across sectors by roughly about 10% or so. So this is going to, and also post the Operation Twist, which the RBI did, it's kind of lowered the borrowing on the long end of the curve, which is where primarily most of the borrowing for Indian companies is. So, and I think that they will have to do, and probably will do, some more Operation Twist to continue to ensure they bring down the long end, which bringing down the interest expense of companies. And all this will lead to an effort in improving the EPS outlook for the third quarter. Now, against this backdrop, earnings for the third quarter is likely to be weak for various sectors. But in the case of autos, they'll probably be slightly better than expected. Banks probably in line, metals probably in line, whereas some other sectors like utilities and all is likely going to be worse than expected.
Chakri, good morning. Neeraj here. Would the overarching bent be towards the broader markets for 2020 or no?
I think the overarching trend, yes, you're right, is likely to be the broader markets for the simple reason that now it's a well-known debate that it's been the rally for this year has been very narrow, contributed not just by the Nifty, but within the Nifty by a handful of about 10 companies. Now, any rally broadens out as the economy kind of bottoms out. So I think we are in a point where, post the corporate tax cut, RBI, continuous actions by the RBI, etc., NPA cycles, all of the good work that has been done will start kind of showing up, but not in the third quarter, but probably towards the second quarter of the next financial. So against that backdrop, that's when broader markets will, ahead of the curve, will start doing well. So I think, yes, the earnings recovery is likely to be slightly more in the broader markets, and they'll begin to participate.
Right, Chakri, there's another theme which is starting to emerge. I mean, it's been around for quite a long time, but I'm talking about the internet-facing stocks. So on one hand, you have something like an Info Edge. On the other hand, you have something like a Just Dial. Then you have IndiaMart, which is an online, and along with something like, perhaps, of course, I've already mentioned Just Dial. But how are you going about some of these companies? How are you going about picking some of these names in those which are facing the internet right now?
Yes, indeed, that's a good question. India has seen a fair degree of unicorns that have come about in the last few years. So against this backdrop, you mentioned Info Edge. They have several good properties within their portfolio of investments. And so it is likely that companies, and they have been very successful in not just identifying investments, but also doing the follow-up fundraising and then sustaining valuations, which is very important in investing in such businesses, because these are, end of the day, unvalued, private companies, and therefore the valuation yardsticks are slightly different from that of the listed yardsticks. So against that backdrop, I think I would rather stick to the Info Edges of the world, which have a portfolio approach to participating in the e-commerce space.
Okay. Chakri, the last three sessions, we've spoken about this on the charts with our experts, but I just wanted your fundamental view. The last three sessions, we've seen re-emergence of sorts of some of the auto ancillaries. Is there merit in trying to own this space? I mean, the outlook on auto itself still not completely clear, still mildly hazy. Would you go out and buy the second-rung ancillaries?
See, the auto ancillaries being primarily smaller companies than the mainline auto companies have fallen much more. The valuations are far more attractive. But on the flip side, they also have some of the better run or larger auto ancillary companies have diverse revenue streams where they supply products not just to four-wheelers, but you would have the same company supplying to both four-wheelers and two-wheelers. And therefore, in a way, they are diversifying within the auto industry. And second, they also have some of the companies which have like Minda or Motherson, these have both export revenue as well as domestic revenue, further buffering further buffering the downside. So against this backdrop, I think in this coming quarter, third quarter, we are likely to see some of the auto ancillaries begin to show up a revival of sales of revenue at the top line, which will flow down to the bottom.
Okay. Chakri, I'm sure you must have heard about Unilever indicating weakness in the South Asian markets, and that would, of course, include India, considering being the largest market. If we were to go with analysts' expectations of around 5% volumes growth, my question then is, can we project that to the entire FMCG sector? Which means, then my question is, can we expect that subdued growth in the entire FMCG sector as a whole, perhaps expecting about no more than 5-6% volumes growth that may impact revenue?
I think the FMCG sector is a combination of both rural and urban demand, and the fact that it's a well-known fact that both these urban and rural had slowed down. On one hand, the valuations have kind of gone fairly up for some of the frontline FMCG companies. Now, against that backdrop, you are now they have had some raw material costs inching up in the last quarter or so, palm oil, for instance. So against that backdrop, I think you'll have the larger companies focusing more on a volume market share rather than trying to compete, rather than a pricing differentiation strategy. So against this, it's more largely operating measures which will try to bring down costs. There is no pricing power really, so it's more a volume game. So I would actually stay away from some of the FMCGs given the evaluation.
Just monitor this. Chakri, my last question to you: we're seeing some continued traction in some of these specialty chemical names. Aarti Industries is up another 3.5%. Some remarkable moves there on that stock. Navin Fluorine is up as well. So people are, even at the end of the year, going out and buying this segment, which has done well. Chakri, as we wrap up this conversation, just one final comment on whether you believe the momentum in this space, which has been there now for the last 4 or 5 years, could well continue going ahead, fundamentally.
Yeah, I think the short answer is yes, the momentum will continue, and for fairly diverse bunch of reasons. One is many of these well-known companies have both domestic and export revenue. Exports are doing fine. Second, they today have a bouquet of portfolio of products which kind of diversifies their revenue streams. And three, their valuations had gone up, corrected, and now looking fairly decent. So against this backdrop, chemical companies, yes, we find them attractive going into 2020.
Okay, Chakri, we'll leave it at that. Thank you so much for joining us and taking us through how you are seeing markets going forward.